Hey guys, welcome back to the Independent Investor Channel. My name is Ryan, coming to you from the Big Apple, New York City, New York. This is part of a series that I've been doing, right, to get your mind kind of wrapped around how you enter the market. And the way you kind of do it is to say, if I had, $1,000 or $5,000 or $10,000 or $25,000, how would I deploy those funds, all right? And these are scenarios that you guys can kind of work through to really kind of help you identify any sum of money, okay? And the reason why we do these in different increments is because it's relative, all right? Not everybody has $25,000 to just drop into the market. Most people have either zero or they've saved up $1,000, so they've saved up $5,000, and they just kind of want to know what their options are with those particular sums of money, all right? Now, this is what I would do with the money, all right? Now, there's 1,000 different ways to approach the market, and you can win with any number of perspectives. On the Independent Investor Channel, we advocate for one account and one account only for new investors who have $0 to $5,500 per year to invest in the stock market. All right, so we're aimed at those folks who are looking to get themselves exposed really from an elementary or a beginning stages to get involved in the market. All right, so guys, enjoy. This is how to invest $10,000, right? If you had $10,000, what would be the best way to invest it, all right? And there's going to be a lot of different perspectives on this. This is just how I would do it, all right? And I would build this for you guys the same way that I would build this for me, and it's the same way that I recommend building it for anybody who asks me this very question. I approach it in the same manner, all right? Now, having $10,000 gives you a little bit more in the driver's seat to make sure that you can do those max fundings, all right? But I think my perspective on how to take $10,000 and carefully introduce it to this particular market. Now, here we are with the last day of September 2017, all right? We are at a time right now where the market is making new high and new high after new high in the S&P 500, and the Dow Jones Industrial Average just keeps creeping higher and higher, all right? So how I would take $10,000 for a new investor right now might be different if we were in an identifiable bear market, okay? And that's where you'll find a lot of the care that I take in recommending how we allocate this money and still keep some money on the sideline really is just in relation to where the market is on this particular date and time, all right? So please enjoy, guys. These are some of the funnest videos I come out with regard to the series of how to invest any sum of money. This is $10,000, all right? The first thing that I like to do is get people of the mindset of preparing to enter the market, okay? Now, I've got fund, and to fund the account, I always advocate for starting the self-managed Roth IRA account, guys. So a lot of people hit me up and they start talking about, should I invest in Micron, or should I invest in AMD, or should I buy NVIDIA, right? And they don't even have an account started, all right? You need to get your ducks in a row, and you need to identify what account you want to open. Do you want to open a Robinhood account, a brokerage account, or do you want to start with that retirement account to start? You need to kind of identify what account is going to work for you in the long term, and what account you're willing to go ahead and start as your first fund or your first account that you're going to start funding the account, all right? So once you take these funds and you start to fund this self-managed Roth IRA account, there is a yearly contribution to that account of $5,500, okay? So naturally, here we are, September. We're a couple months away from the new investment cycle starting, okay? So if I had $5,500 to start, I would go ahead and max fund that self-managed Roth IRA account. That's going to give you that direct funding to draw from, all right? And it can come in a lot of different ways. I've had folks start their self-managed Roth IRA account, and they've got other funds in other accounts that need to be either transferred over, or they have an existing Roth IRA, which was my case. I had a managed Roth IRA that I was able to take the managed Roth IRA and roll it into my self-managed Roth IRA with incentives, I might add. So I've got a lot of people out there with in a lot of different stages, all right? But the very first stage, assuming that you've prepped your emergency fund and you've got yourself with your debt under control, all right, the very next stage is to start your account, all right, and fund that account. And once that account is funded, it should take a few business days to clear. It's going to enter into this money market account. And now once it's funded and those dollars are in that money market account, now those funds are ready to be deployed into the market as you see fit, all right? So honestly, guys, getting people to that very stage right there in investing is hard enough, okay? I've got people approaching me all the time talking about, I don't know squat about the market. I'm dumb. I don't know anything. I don't know I don't know how to do this. I don't know how to do that. Blah, 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 blah. And they've been using the same excuse their whole life as to why they can't get to this particular stage here. This is free. Everything I've explained to you up till now, if you've got these dollars to invest, all you've done is taken $5,500 from this $10K and funded this account. You haven't invested a dime yet, okay? All you've done is prepared that account to deploy funds in the market. Now, a lot of people would be just as comfortable with sitting on those dollars and maybe wait till a better entry into this market. In my professional opinion, I really don't think we're going to get that. In any extreme circumstances. I don't think we're going to get a downturn of 20, 30, 40% in this market. I really don't. I really see maybe rotations of dollars as this market is super high. So you have sector rotations of monies going from some of the hot sectors into some of the less liked sectors like energy, materials, transports, okay, some of those sectors. But those are only causing ripples into this market, all right? So I don't necessarily advocate, if you took $5,500 and funded this account, that I would just advocate for keeping 100% on the sideline, all right? There's a reason why you're going from a non-investor to an investor here, and this $5,500 is going to be deployable as soon as you get it into this self-managed Roth IRA account. $5,500 is going to be sitting in this money market account ready to be deployed, all right? Now, a lot of people ask me, okay, it's funded, I'm at that stage, what do I do now? The very first thing I'm going to recommend, especially for the new investors out there, okay? And I've seen a lot of unique transfers, I've seen a lot of unique liquidations to make this transfer happen. But at the end of the day, guys, I want to get you into the primary vehicle that's going to be with you for the long haul, okay? Because whether or not you are 25 years old, okay, or you're 35 years old, all right, and you're looking to start this account right away, I want to get you into what I'm going to consider your flagship account or your flagship fund, all right? Now, there's two ways that we can pick up a flagship fund, all right? The first way that I recommend is an ETF, all right? It's an exchange traded fund, which allows you to buy either the entire market, or you can buy pieces of sectors, or you can buy subsectors within the market, all right? And the ETF is a beautiful way of entering people into the market responsibly and diversifying them right off the bat, okay? What that's going to allow is most of the ETFs, or at least the ones that I recommend, and I've got two of my favorites over here identified, which is the VOO, the Vanguard's ETF, that allows you to enter into the market diversified right away. And that way we can build those funds up year in and year out. And that can be really the fund that we carry, you know, either $5,000 is or $50,000 or $500,000 into the future, all right? So 10, 20, 30, 40 years down the line, this is going to be basically our flagship stock or ETF that we own, and it's going to be really that baseline in this account that we're looking for. We're looking for that solid year-over-year return, all right? The VOO has returned close to 15% year-over-year. The SPY has returned close to 11% year-over-year, all right? So this is going to be my first recommendation here. The drawback that I see with index funds, and I don't recommend mutual funds. I think mutual funds are a thing of the past. I know Ramsey would beat me up over that because he's got his proprietary proprietary niche mutual funds that are outpacing the market. And I know those products are out there, but they're really hard to find. And I'd be hard pressed to recommend it to you guys with the expectation that those mutual funds are going to outpace the market and also outpace the expense ratio that it's going to cost or the management fees that it's going to cost to carry that mutual fund. All right. So the fees are over here, the outpacing or the alpha is over here. And when you wash them out, all I care about is the year-over-year performance, all right? And these right here, guys, 96% of money managers fail to meet the benchmark or the industry benchmark. So if you just buy the S&P 500 through this ETF, chances are you're going to outpace money managers anyway. And since I'm putting you into the self-managed account, right, you keep all the profits. You don't share them with anybody, all right? Expense ratio in the VOO is 0.04%, guys. It just doesn't get any better than that, all right? So everything that the VOO makes you over the long term is yours to keep, all right? A lot of index funds will allow you to dollar cost average, but also dividend reinvest. The ETFs are just going to provide you a cash dividend, all right? So the ETF is something that I'm going to recommend to buy. And if we have $5,500 to buy, certainly we can put 3,000 of those dollars into a nice ETF. Go ahead and buy 10 shares of the VOO and we're good to go. There we are. We've got our diversified product. Leaves us a little bit of pay dirt left over to look at the third piece to this leg. Now remember, guys, this is year one. This is year one. All right. And you think, man, $5,500, Ryan, that's a lot of money, man. That's a lot of money. I'm going from a non-investor and $5,500, boom, is in this account right away. Yeah, it is, guys. But you got to understand where you're going to be after 5 years, after 10 years, 15, 20, and so on down the line. You're setting that firm foundation from nothing. Okay. You're going from nothing to something. All right. Now look at what we're accomplishing here. We're accomplishing diversification. We're accomplishing entering the market in a self-managed Roth IRA account. So we're eliminating the fees. We are eliminating the tax implication because I expect that you guys are going to be holding this at least until maturity at 59 and a half until you get closer to retirement. At 59 and a half, we can look at it. If it's a down market, you can let it continue to ride. If it's in a market high at that particular time, then you could have the option to start taking withdrawals on that money tax-free and wealth protected at that time, all right? So when we get down here, even in year one, certainly we can exercise the option of adding a couple of stocks here. Now, our stocks that we're adding at this particular point, is it going to be NVIDIA, Micron, AMD? Is it going to be Sprint in the telecommunication? You know, is it going to be some of those riskier assets? Is it going to be Sirius Satellite Radio? You know, is it going to be some of those? Absolutely not, okay? We're a beginning investor, so what we're looking to do is grab the most quality of quality names out there to start. All right, quality of quality. And I've got here, what we're trying to do is grab some sector exposure, and we're trying to grab the best quality names that we can, because we're looking to buy these names and we're looking to stay in them for the long term. We're not looking to trade out of these positions, all right? So we're looking to get exposure to the sectors. Now I leave the sectors up to you guys. I can recommend that you go with Apple and Disney. Those would be my first two stocks. If I was looking to add, you know, the VOO or the SPY as my S&P 500 diversified product, and then I was actually adding a couple legs into this account, it would be Apple and Disney. Those would just be the two. All right. Now there are negatives with every stock, okay? But we're trying to pick the best breed to start this account off on the right foot. So if we do get a market correction, we're willing to take those good names into that market correction and maybe add more to them, all right, when we contribute more to this account. Or we experience some appreciation within this account, all right? Another reason why we add single stock allocation to this right away is that we can set this up on dividend reinvestment, and we can set this up to start reinvesting and accumulating shares for ourselves right away, all right? Now, the impact right away isn't going to be quite as evident to you guys, but I want you guys to start the mental conditioning, right, of watching your assets appreciate and watching your share base accumulate as well, all right? Now, if you wanted to keep a small piece of 20% cash back in this money market account, I'm okay with that. Or if you want to just take that entire thing on year one, because this is $5,500 out of this $10,000, we've got $4,500 waiting until January 1 of the following year, right? We're going to have to add a little bit to that to max fund on the following year, but I have no problem with you guys going ahead and either keeping 20% of that contributed $5,500 in that account. So if you do get a little pullback in Apple, if you do get a little pullback in Disney, or if you want to take a position in a third stock, you certainly can. Buy a Mondelez. You know, buy a Blackstone group. What about adding a limited partnership to this? If you wanted to go ahead and buy the financial allocation in Wells Fargo, go ahead and do that. If you want to buy a piece of Procter & Gamble or Johnson & Johnson, all right, some of these good names, you can do that. But on year one, guys, you're not going to be able to buy them all, okay? So I say pick the best two. So you've got your diversified asset here, and you've started the single stock allocation within your self-managed Roth IRA account. Guys, that's the best way that I know to take $10,000 and introduce it into the market in the correct manner. Guys, thank you so much for tuning in. If this is your first time tuning into the Independent Investor channel, please hit the subscribe button for me. You'll be notified of any future videos that I put on YouTube. Share this link with anybody out there that you know who could benefit from stock market information or is looking to get invested and is a beginning investor. They can really benefit from the information on this channel. Leave your commentary at the bottom, as I do review and reply to all my commentary on my channel. Guys, thank you so much for tuning in to How to Invest $10,000. Good luck in your investment future.